Welcome to the Expert Network
The Expert Network team consists of Karl Frank of A&I Financial, Mike Miller of Miller and Associates CPAs, Jeff Krommendyk of Security First Insurance Agency, and I'm Nathan Merrill. I'm an attorney at Goodspeed and Merrill.
Together, our independent team combines our expertise to provide you insights and solutions, some straightforward, some profound, for real-life opportunities we see on a daily basis. We hope you enjoy the information contained in today's podcast and find it useful. If you'd like to learn more or desire to meet with any of the Expert Network team members in person, you can contact us at info@expertnetworkteam.com. That's info@expertnetworkteam.com.
And we encourage you to take advantage of a free consultation with any of our team members. Just mention this podcast when you schedule your appointment.
Now on to today's podcast. Welcome to the Expert Network team. I'm Nathan Merrill of Goodspeed and Merrill, and today I have with me Karl Frank and Cameron Morgan, both of A&I Financial. We're going to have a bit of a free open mic session here. Not too much of a planned topic, but something that's been on my mind lately, and I really wanted to present it to Karl and Cameron and get their insights, because I'm not one who follows the markets. I'm not one who evaluates investment qualities and investment options. But one thing I've been hearing a lot on the street, as it were, is that with all this money that's been surging into the markets lately, that things have tended to get overpriced. So perhaps Karl and Cameron, you can speak to, is the largesse of the most recent government printing program partly to blame for this uptick in the market, and where are we at in terms of, is it a good place to see our money put to work long term as things stand right now?
Thanks, Nate. Man, it's great to have that question asked. I really appreciate it, and we hear it all the time too. Cameron, maybe I'll start and we just take turns if that sounds good to you. I was thinking about that actually earlier today, because I had another client ask me, well, should I be investing this lump sum of money today after all these all-time highs? Is that the right thing to do? I mean, it just doesn't feel like the market's going to continue to go up. And so I did a little research, because this isn't the only time we've had all-time highs. Actually, we've had them pretty recently, and we've had them really good in very recent past. And so I did do that, and believe it or not, intuitively or not, our emotions are sometimes the worst gauge of when to invest. I was talking to another real estate investor today, and he's telling me how he makes his investment decisions on real estate, and he wants to diversify out of it because he's got so much money in it, and when do I go into equities? And so, two different conversations, same concern. Like, it feels like for the second person I was talking to, real estate's at an all-time high. How can I possibly be investing? And in both cases, sometimes our emotions are the worst way to time the market. I've got research on the screen. I'll put it in the liner notes from next week's Periscope newsletter that we send out weekly. You can sign up for that at our website, assetsandincome.com. But when you have a new high, when today's all-time stock market record is high, like it's never been as high as it was, 56% of the time, tomorrow is going to be an even higher high. Your odds actually increase after you've had all-time highs in the equity markets, that the next day is going to be even higher. And I'll shoot that out, but so sometimes the best time to invest actually is near the high.
I think I've certainly gotten this question from a number of clients, and have considered the same thing myself over 30 years of investing all over the world. It always looks too high. It always looks like, because we know the details, right? We know that that most of our financial surprises are to the negative. I mean, how many times have you gotten a sudden expense for $200? A broken windshield, or a flat tire, or a medical copay. $200 expenses pop up almost every month. And when you compare that to your lived experience of how often have you found $200 on the sidewalk and just gotten to pick it up and put it in your pocket, that almost never happens. So I think we tend to see the bad things, we tend to see what could go wrong, and we tend to be a little skeptical that the market is including all this bad news. And surely at some point this bad news will come in and it will make the market go down. And it just doesn't really happen that way, even though it feels like it should or it could. It feels like the market's out of touch with reality. The market isn't in touch or out of touch with reality. The market just keeps marching along. So I'm with Karl on that. I don't have too much concern that, who knows? We don't know what the future holds. But the market's hit, I think, over 70 new highs just this year, just in 2021. And I don't know how many new highs it hit in 2020, but there were definitely a bunch. And it didn't really track with our lived experience. But I don't think I've ever found $200 on the sidewalk. So I'm going to keep on investing, even though.
There's always the PPP loan.
Yeah, that's true. That was $200 on the sidewalk. that
was a once in a lifetime. So
where was Mike Miller for that?
Really.
Mike talked about that.
So going back to that though, how much of this market thrust is driven by just simply more dollars chasing scarce goods?
Mm-hmm. Yeah, no, that's a really good question. That's impossible to answer directly, but yeah, clearly we have a bias that the right way to invest is to diversify by opinion. And our research, some of our researchers, we diversify by at least 5 different ways to make your money. And some of them are going to agree exactly 100% with you. And they're going to say, absolutely, there's a lot of money chasing scarce goods. And the more money that we have in the world markets, not just with the U.S. Federal Reserve, but other reserve banks around the world, prices will naturally inflate. And so some of those researchers 100% agree, and they'll absolutely tell you that that's what's driving the markets, and there's reasons for great caution. And other researchers will tell you that's not what's going on. And we're going to divide the line somewhere in the middle and tell you, you know what, you one of these guys or several of these men and women are going to be right. You just never know in advance which one's going to be more right.
And I really love the phrase we've been using around the office for the last 2 or 3 years, which is this acronym TINA. There is no alternative, TINA. It sounds kind of mean to say there is no alternative, but when you look at the next step for someone who's concerned about overpriced stocks, so the next step might be sell their stocks. And then the next step after that is what? So that's another question. Sort of, do you buy bonds? Do you sit in cash during an inflationary time? Do you buy real estate? Do you buy gold? And we keep circling back to stocks.
Well, you could deleverage, I suppose, but that depends on what kind of debt structure the individual has. But that's one thing I've seen people do.
Nate, that's a really good question. So I love this deleverage idea because there's 2 sides to that coin. So let's say you're worried about all the money in the market and you're worried about inflation. Do you want to deleverage now or do you want to wait until later? And financially, it's actually a really good idea to not deleverage, to take on more debt now, to pull the money out. Right? Because then you're going to be paying back that debt later when the dollar's worth less.
Right. Assuming that the dollar that you took out retains its value. And I think that's the concern, and obviously where you guys factor in is how much risk do you take on with that dollar that is an absolute payback obligation with a dollar that doesn't have an absolute return tied to it.
Mm-hmm.
Yeah, right. So if I take out a mortgage, let's do some, simple math. If I take out a $100,000 mortgage, and I know my dollars are worth whatever they're worth today, right? $3, maybe $4 buys me a gallon of milk, unless I go to Whole Foods and I need like $7, right? But I know what the dollar is going to get me today.
Just give them your wallet.
Right? Or I just walk out the door because I've got the Amazon app and it's tracking me anyway. All right, so we digress. But I know what the dollar is worth today. But I know that I'm never going to owe more than $100,000 to the bank for my mortgage, right? It doesn't go up in value. But if I think the dollar is going to go down in value over the next 10 years, and that same gallon of milk that I'm buying for $3 today might cost me $5 in 10 years or whatever I'm worried about, right? Then it'd be a good idea to keep that mortgage today, because I'll be paying back that absolute $100,000 value with dollars that are worth less later, and I'll get more utility out of my money today. Crazy,
Sure.
isn't it?
Sure. No, I agree with that. It's just, where do you get this constant supply of money to increase your dollars that you're paying back? I guess the concern that I was expressing, or that has been expressed to me, is if I take out that money and it's an absolute obligation to pay it back, and I put it in the market, and the market does go the wrong way, then I still have to come up with the money, but my dollars are now less. So
I like it. Yeah.
So
Yeah.
maybe a dividend strategy or something like that would make more sense than putting it into growth and that sort of stuff. But I'd leave that up to you guys, the professionals. Let me throw another little curveball at you, because this is a guy that gets a lot of airtime, and I'm just going to be a little contrarian here, because that's what I'm good at. Is the Warren Buffett. When everybody says that the market, there's no end in sight, that the market's going to go up, 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 isn't he known to have said that's when you want to sell? Am I getting that right?
Yeah, I mean, he definitely did not participate in the tech bubble of the late 90s, and his take was he couldn't really understand it, and that he knew the fundamentals weren't there. If there's a company making a loss and it goes public, there's nothing to buy, and it should not have a share price. So he avoided.
Are we seeing any of that today?
I'm not seeing Warren Buffett stepping aside, but his technique is definitely that deep value strategy. He buys companies that he wants to own, and that he thinks are undervalued. So he's sitting on, I think, over $4 billion in cash right now. He's sitting on a lot of cash, but he's also sitting on a lot,
not for him.
Right. And that's the thing. He's got more money invested than he has on the sidelines. He has a lot on the sidelines compared to what he, what he could have on the sidelines, but he still has more invested than he has on the sidelines. So I don't know if that's helpful at all. I think, his approach of living a pretty modest lifestyle and spending all of his time, studying stocks is not a lifestyle most people want. At least they don't want the studying part. They don't mind the wealth that he has, but most people don't want to live a modest lifestyle and spend all day studying stocks.
Yeah, definitely not. And that's a great analogy, Nate. I love it. And Warren Buffett certainly is, not our area of expertise. I think his style of investing is something that we love. But one way to measure whether people are overly attracted to stocks is something put out by the AAII. They're the Association of Individual Investors here in the U.S. And they put out a sentiment, and they just ask their investors and what they're thinking. And when a lot of the individual investors think the equities are only going to go up, it can be a contrarian indicator. And how reliable that is, I don't know. We don't use it, but it's a well-known contrarian indicator that when people are feeling really good, the markets are more likely to go down. And right now, it's not that bullish, right? So I just looked at the week ending November 3rd, 2021. 41.5% of those folks think that the market is going up. The rest of them don't. So that's not that bullish. The 52-week high, according to that sentiment, is over 50%. And I can tell you from experience, back in the .com era, when I was cutting my teeth, everybody in my office thought they could only always go up, and everybody planned on, making enough money to buy a BMW by 9:30 in the morning off an IPO that they bought at 9:01. So, this is not that crazy market. We got a lot of really worried people.
I'd love to add something on here, and I hope you're able to put this information in the liner notes, Karl, because what's interesting to me about this chart is that it's a weekly sentiment vote, and yes, this week only 41.5% of the people surveyed in the AAII feel the stock market will be up in the next 6 months. So 41.5% are bullish. But 2 weeks ago, on the 20th of October, 46.9% of them thought that it would go up, and up it went. So it's interesting to see that
leading or lagging?
Yeah.
Yeah. Not saying that they're predicting, anything in particular, but
There's a lot of feeling.
there's a lot of big feelings here. I did just open up my snail mail today I got my September 30th statement for my investments, and I was like, it's already November. This is so out of date. So
Right.
I didn't worry too much about my 9/30 statement because I know October has been a surprisingly strong month. So it continues to surprise. That's the main thing we know.
So I'm going to give you one more quick topic to address, and tell me your thoughts on this. So last Friday, the what was formerly known as the bipartisan infrastructure bill was passed, 1.2 trillion, I believe, in spending. A fair amount going into infrastructure, a fair amount going other places. When you look at spending like that, targeted spending coming out of DC, do you ever look for industry opportunities in the anticipation that that money is going to find its way into Caterpillar, stock or other related industry companies?
Great question. No, it's a great question. And so that is an approach that's used by our strategists. So like I said, the right way to manage money is to diversify by strategy. And absolutely some of our investment managers are doing that. And I think, that's a funny example, Caterpillar, because their stock's already risen and perhaps on hopes of that. I think that stock is it could be part of a person's portfolio, and it's not a recommendation, just the fact that you happen to mention it. But there's a lot of money being invested already in hopes of that, and that's one strategy that is used by some of the strategists who we employ. At our firm, we focus on allocating that, and then really about the client's individual financial plan and how much of that is right for them will be a unique story in a unique situation. And I think that, we could put our investment track record up against anybody, and we would shine pretty well. But the core belief is unchanging, that the financial plan determines the investments. The investment's success or lack of success shouldn't drive the plan.
Sure. So maybe the way I positioned that as a question to you and your approach, it wasn't the best, but it sounds like there is some there that when the government issues some big spending, that money's going into something, and someone's taking that into account when they're evaluating portfolio construction and
Oh yeah. And I think a lot of senators and Federal Reserve members are in the hot seat this year because they're already placing their bets before the rest of us have access to that non-public info.
Mm-hmm. The other thing to keep in mind that when I look at the kind of big picture of the U.S. economy, government spending is a part of our GDP, but consumers in non-COVID years, consumers make up about 72% of our economy. And so the consumer wallet is what's driving economic growth and has been for decades. Yes, a large government contract is going to be very beneficial for a company that wins that contract. It's going to, create jobs, it's going to create profits, it's going to create some share price moves, I'm sure. But underlying that, we have the very, very powerful American consumer, and that's where we're seeing things like Google, which is up 70% this year, which is an astounding number for a company. And I think we're going to continue to see the U.S. consumer be the driver of our economy, not just the government. It's definitely government contracts benefit, but it's not the only thing.
I thought Google was a country. You're telling me that's just a company?
It's larger than most countries, yes.
Well, you guys have held up well under, again, another round of cross-examination here from my unseasoned lawyer strategies.
You're a great interrogator, Nate. We really appreciate it. Thank you for the opportunity.
It's been a great conversation. Good to get some of these ideas out of my head and into the marketplace, as bad as that is. So thank you for your time.
Podcast.
Yep. Thank you for your time. And to our listeners, we hope you have a wonderful evening, wonderful afternoon, and until next time, make it a beautiful day.
Great, beautiful day, buddy.
Thank you for joining us today. Hope you enjoyed the information we shared.
If you enjoyed this podcast, please feel free to share it with someone else, and join us next time.
If you want to meet with a member of the team, please contact us at info@expertnetworkteam.com. That's info@expertnetworkteam.com.
If you have special topics you'd like to hear about, please reach out to us and let us know at the same email address. Again, that's info@expertnetworkteam.com. Thank you for joining us and have a great day. Thank you for listening to this podcast. We want to remind you that listening to this podcast does not establish a client-professional relationship with any of the firms represented, nor does it constitute legal, investment, or accounting advice, and the views are those of the professionals only.
Investment advisory services may be provided through A&I Financial Services, and securities may be provided through Genios Wealth Management.